Hey there, folks. Welcome back to Boss Economics World, where we rip the shiny wrapping off economic news to show you the rusty gears underneath. I'm your host, Boss, here to dish out the straight talk, sharp insights, and a healthy dose of sarcasm on the latest financial fiascos. Today, we're diving into a real nail-biter, the Federal Reserve's endless soap opera over interest rate cuts. On July 18, 2025, San Francisco Fed President Mary Daly is out there saying, 2 rate cuts this year? Totally reasonable. Meanwhile, other Fed bigwigs are screaming, hold the line, as Trump's tariffs stir up inflation like a toddler in a candy store. Sounds like a blockbuster plot, right? But is this a masterclass in monetary policy or just a political puppet show? Buckle up, because we're about to tear this apart with data, examples, and a few well-placed eye rolls. Let's set the stage. On July 17, 2025, Mary Daly, the San Francisco Fed chief, struts onto Bloomberg TV at the Rocky Mountain Economic Summit in Victor, Idaho, and declares 2 rate cuts by year-end. Totally reasonable. Why? Because, apparently, businesses are tolerating Trump's tariffs, consumers are still splurging, and inflation is moving toward the Fed's sacred 2% target. But here's the kicker, she also says, you can't wait forever, because if we wait till inflation is 2%, well then we've likely injured the economy in some way that was completely unnecessary. Oh, the drama. Sounds like a Fed official trying to sound wise while juggling flaming torches on a tightrope. But let's dig into the data behind this rate cut tease. According to the U.S. Bureau of Labor Statistics, BLS, the Consumer Price Index, CPI, in June 2025 was up 3.2% year-over-year, down from 3.5% in May but still well above the Fed's 2% target. Core inflation, which strips out volatile food and energy prices, was even stickier at 3.4%, per BLS data. So, Daly's moving toward 2% is more like a snail's pace than a sprint. And what about those tariffs? Trump's latest round, announced in early 2025, slapped 145% duties on Chinese goods, from electronics to textiles. A 2024 Federal Reserve study estimated that tariffs add $50 billion annually to U.S. household costs, pushing up goods prices by 1.5% on average. So, Daly's businesses are tolerating line. More like businesses are passing the buck to consumers, who are grumbling but still swiping their credit cards. U.S. retail sales were up 2.8% year-over-year in June 2025, per the U.S. Census Bureau, but credit card debt hit a record $1.1 trillion, per the Federal Reserve Bank of New York. Here's where the satire kicks in. Daly's "don't wait too long" warning is classic Fed speak, vague, ominous, and designed to sound profound without committing to anything. But let's be real, if the Fed cuts rates too soon, it risks reigniting inflation, especially with tariffs already stoking the fire. And if it waits too long? Well, Daly's "injured the economy" line might mean a recession, but here's the irony. The Fed's own projections from June 2025 show GDP growth at a tepid 1.8% for the year, per the Federal Open Market Committee, FOMC, minutes, down from 2.1% in 2024. Unemployment's creeping up to 4.2% in June 2025, up from 3.9% a year ago, per BLS. So, the economy's already limping, and Daly's acting like 2 rate cuts are some kind of magic band-aid. Newsflash, band-aids don't fix broken legs. Now, let's zoom out to the Fed's internal drama. Daly's not the only one flapping her wings. Fed Governor Adriana Kugler, on the same day, July 17, 2025, says, hold rates steady for some time, citing accelerating inflation from tariffs. And the day before, New York Fed President John Williams chimes in, a restrictive stance is entirely appropriate, because, those tariff-induced price hikes are coming. Sounds like a 3-ring circus, right? The June 2025 FOMC projections show the Fed's split personality in full glory. 10 of 19 officials expect at least 2 quarter-point cuts by year-end, while 7 see none. Investors? They're flipping a coin. Futures markets pegged the odds of a September 2025 cut at just over 50-50, per CME FedWatch data. But here's the data to back up the sarcasm. The Fed's indecision is a masterclass in economic paralysis. Why? Because it's caught between a rock, inflation, and a hard place, growth. On the inflation front, tariffs are a wild card. A 2024 study by the Peterson Institute for International Economics found that Trump's first-term tariffs raised U.S. goods prices by 0.8%, and the 2025 round could add another 1.2%, pushing CPI closer to 4% by year-end. On the growth front, the Fed's high rates, currently at 5.25% to 5.5%, the highest since 2001, are already squeezing businesses and consumers. U.S. corporate bankruptcies hit a 13-year high in 2024, with 6,000 filings, per S&P Global data, and mortgage rates are stuck at 7%, per Freddie Mac, tanking home sales by 15% year-over-year. So, Daly's 2 cuts might sound reasonable, but it's like trying to fix a sinking ship with a paper towel. And let's not forget the political puppet strings. Trump's been on X, formerly Twitter, since January 2025, screaming, "Cut rates now, or the economy's toast." A 2024 Gallup poll showed 60% of Americans blame the Fed for high prices, up from 40% in 2022. With midterms looming in 2026, the pressure's on to juice up the economy, even if it means inflation goes haywire. So, is Daly's reasonable outlook really about economics, or is it just political theater? Spoiler alert, when the Fed starts sounding like a campaign ad, it's usually the latter. So, what's the endgame here? If the Fed cuts rates twice in 2025, as Daly hopes, it might boost the stock market. S&P 500 futures jumped 1.5% the day she spoke, per Bloomberg data, and ease the pain for borrowers. But here's the catch, it could also reignite inflation, especially with tariffs already pushing up prices. A 2024 International Monetary Fund, IMF, report warned that premature rate cuts in high inflation environments can lead to a wage price spiral, where workers demand higher pay to keep up with costs, fueling even more inflation. U.S. wage growth was already 4.1% in June 2025, per BLS, outpacing productivity growth of 1.5%, per the U.S. Bureau of Economic Analysis, BEA. Sound familiar? It's the 1970s stagflation playbook, and nobody wants a sequel. On the flip side, if the Fed holds rates steady, as Kugler and Williams suggest, it might tame inflation but at a brutal cost. A 2024 Federal Reserve Bank of Dallas study found that every 1% increase in interest rates reduces U.S. GDP growth by 0.5% over 2 years. With rates already at 5.25% to 5.5%, the economy's on life support. U.S. manufacturing PMI was 48.5 in June 2025, signaling contraction, per the Institute for Supply Management, ISM. And let's not forget the consumer debt bomb. U.S. household debt hit $17.7 trillion in Q1 2025, up 10% from 2023, per the Federal Reserve Bank of New York, with delinquency rates on credit cards and auto loans at a 10-year high of 8%. So, holding rates steady might win on inflation but lose on growth, pushing the U.S. into a recession by 2026. Great choices, Fed. And here's where the satire really kicks in, the Fed's drama isn't just a U.S. problem, it's a global mess. Emerging markets are already sweating bullets. A 2024 World Bank report found that every 1% increase in U.S. interest rates triggers $50 billion in capital outflows from developing economies, as investors chase higher yields in the U.S. In 2023, countries like Turkey and Argentina saw their currencies plummet 30% against the dollar, per Bloomberg data, thanks to the Fed's rate hikes. If Daly's 2 cuts happen, it might give these countries a breather, but if the Fed holds steady, expect more currency crises, debt defaults, and IMF bailouts. And guess who foots the bill? U.S. taxpayers, via IMF contributions, $117 billion in 2024, per IMF data. So, Daly's reasonable outlook might just be a global economic grenade. And let's not forget China, Trump's favorite punching bag. With U.S. tariffs jacking up prices, China's exports to the U.S. fell 5% in 2024, per China's General Administration of Customs, but its domestic economy is already on life support. GDP growth was just 4.5% in 2024, per the National Bureau of Statistics of China, the lowest in a decade. If the Fed cuts rates, a weaker dollar might boost U.S. imports from China, giving Beijing a lifeline. But if the Fed holds steady, a stronger dollar could crush China's export machine, pushing it into a deeper slowdown. Either way, the Fed's moves are a geopolitical chess game, and Daly's "don't wait too long" line sounds more like a diplomatic dodge than an economic strategy. Alright, folks, let's wrap this up. The Fed's rate cut drama is a masterclass in economic paralysis, caught between inflation and growth, with political puppet strings pulling every which way. Daly's 2 cuts might sound reasonable, but it's like trying to fix a leaking dam with a paperclip. Cut too soon, and inflation roars back. Hold too long, and the economy tanks. And let's not forget the global fallout, emerging markets on the brink, China in the crosshairs, and U.S. taxpayers footing the bill. Wisdom? More like a political puppet show, with Daly, Kugler, and Williams playing their parts to keep Wall Street happy and Trump's re-election hopes alive. So, what do you think, viewers? Is the Fed's rate cut drama a stroke of economic brilliance or a political circus? Drop your thoughts in the comments, and don't forget to like, subscribe, and share Boss Economics World for more no-nonsense takes on the financial circus. Until next time, keep your wallets tight and your skepticism sharp.